Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning back on the program today for part 2 of a 3-part series is Mike Beck. He's an expert on everything in the EV space. So last week we did a piece on lithium. This week we're going to be talking about cobalt. And next week we're going to round things off with nickel. And in fact, Mike, it might make sense to do a 4th one even on copper at some point. Welcome back to the program.
Thank you very much. And yes, copper, I think, will increasingly become topical as part of the battery metal theme for sure.
And Mike, being that we just had Nick French on the program, he's an expert on everything cobalt, has spent his entire life in the cobalt space, and his title of the interview that we put out was Going Over the Cobalt Cliff, which, as you can imagine, refers to the fact that cobalt has a big problem coming up. I think that's a good place to start. What is the problem with cobalt?
Well, I know Nick well, and he is, in fact, I would concur, one of the leading industry experts and has spent a good part of his professional career trading cobalt, so he knows the metal intimately. Cobalt is particularly interesting as a battery metal. It is probably of the 4 key battery metals, that is lithium, cobalt, nickel, and copper, by far the most supply constrained. And let me just elaborate on that a bit. So total mine supply is on the order of 100,000 tons a year. Just to put this in perspective, this represents about 0.5% of the copper market volumetrically. So cobalt is really very much a niche metal, and 50% of its current demand is related to battery, and the balance is related to use as an alloy, or particularly for the aerospace industry. What makes cobalt particularly interesting for us as investors is a couple of unique characteristics. One is that 65% of the current cobalt supply comes from one country, and this country is the Democratic Republic of Congo, which is perhaps not the most stable of countries. So there's sort of a lingering concern by end users of something happening in the Congo that would restrict supply, since 2/3 of it originates from the Congo, and the Congo has periodic fits and bouts of instability. The second characteristic, which is unique to cobalt as a battery metal and not shared with the other key battery metals, is that it is a byproduct of the production of other metals. In particular, it's a byproduct of certain copper production and certain nickel production. And with one exception, which is a cobalt mine in Morocco, 99% of the cobalt occurs simply as a byproduct of the production of the other 2 metals, and typically represents less than 10% and often less than 5% of the mine's revenue stream. And this makes it particularly interesting from a supply response standpoint, because if cobalt prices increase dramatically, it does not necessarily incentivize new supply, since it is a byproduct. Either the copper prices would have to go up to stimulate more production of copper from a mine that just happens to have as a byproduct a small stream of cobalt, or similarly for the few nickel mines where cobalt is also produced as a byproduct. So this makes for almost a perfect storm. If you look, for example, at some of the projected electric vehicle or EV adoption rates, and if you assume, for example, by 2025 that 15% of the passenger vehicle market will be electric, and you do the arithmetic where the average cobalt content per vehicle, electric vehicle, is on the order of 10 to 14 or 15 kilograms, this implies that cobalt mine supply needs to grow by a factor of 3, i.e., total mine supply has to go from what it is today, which is 100,000 tons per annum, to 300,000 tons per annum by 2025. That's a pretty tall ask, particularly for a metal which is produced almost exclusively as a byproduct of another metal. And so unless copper prices or nickel prices dramatically increase, it's unlikely that there'll be any material increase in cobalt supply, and certainly shortages will emerge, and prices will escalate. So that's that makes cobalt particularly unique. Now, cobalt prices have gone in the past year from, and Nick probably talked about this, from $10 a pound to currently at $31 a pound. That's a big move on paper, but if you compare the current price of $30 a pound with, let's say, the 20-year historic average, the 20-year historic average price is $24.75 a pound, or $25 a pound. So even with the big move we've had in cobalt prices the last 12 months, they're still only about 20% higher than their 20-year historic average. So I think as an investor looking at this, what do I think is going to happen? I think that as we move into 2018, we're going to see a further dramatic increase in cobalt price. I think that shortages, severe shortages, will manifest themselves in the supply chain. And I'll give you just one simple example. So Tesla, which is familiar, I think, to all your listeners, is planning to begin production of their Model 3 vehicle, and it is slated for production of 500,000 units per year. A Tesla Model 3 consumes something on the order of 10 kilograms per unit times 500,000 vehicles. That's 5,000 tons of incremental cobalt that presumably would be required next year. That represents 5% of total current mine supply, and that's strictly demand coming from one particular model from one particular manufacturer. And if you multiply that out by across the auto manufacturers, particularly in China, and all the new EV offerings that will manifest themselves starting next year, you can see rather clearly how quickly and how dramatically cobalt shortages can emerge, and when you have shortages, prices go up. Cobalt is also highly price inelastic, which is also an interesting feature. So at the moment, cobalt represents about 1% of the sticker price, let's say, of a Tesla Model S. So if the cobalt price goes up 5x from $30 a pound to, let's say, $150 a pound, just for purposes of illustration, then the knock-on effect in the final cost of the vehicle would move it from 1% of the sticker price of the vehicle to 5%. Still manageable, and nobody's going to stop producing electric vehicles because the price of cobalt has has gone up 5x, and so the supply chain can absorb rather dramatic increases in cost without destroying demand. So for all those reasons, I'm very bullish cobalt, as I am lithium and some of the other battery metals, but cobalt is unique because of these rather special characteristics, i.e. 65% of the supply coming from a very unstable country, Congo, and also the fact that 99% of cobalt supply comes as a byproduct.
And Mike, further to your point, Nick relayed his assertion that there simply is no price that will incentivize more cobalt production. As you pointed out, cobalt is a byproduct, and he said that no realistic price would actually flip that dynamic. Instead, the only thing that could add extra supply is that as cobalt prices go up, some of the non-EV applications would start to look for alternative metals to use because the price would move up so much. But what do we do if we actually reach 25% EV adoption? If you can't get a hold of a metal, how do you actually create those vehicles?
Well, that's a good question, and I wish I had an answer. And I've scratched my head the last year and a half since we started looking at cobalt, wondering the same. There will be a few things that will help relieve the supply pressure. For example, the battery makers, particularly the cathode makers, where cobalt is mostly consumed, are expediting their efforts to move their chemistries toward higher nickel and lower cobalt, but there's a limit to how much of that can be done. So, for example, now for NCM, which is maybe the predominant battery chemistry, that the mix is 532 or 622. That's nickel, manganese, cobalt ratios. Manufacturers are aggressively moving forward with plans to move the chemistry to an 811, and that would reduce the cobalt requirement in those chemistries by half and substitute more nickel. But it's not without its technical challenges. Cobalt is part of the chemistry mix for batteries, not so much for performance, but more to mitigate thermal instability, i.e. spontaneous combustion. So there's the manufacturers and the cathode chemistry guys are moving rather cautiously to an 811, but that transition is going to take 2, 3, 4, 5 years. But that will help, certainly at the margin. No doubt there'll be more artisanal production from Congo. This is sort of informal, small-scale mine production, but it is very problematic and often involves underaged labor. And you may have seen just in today's Financial Times, there was a front-page article that the LME, the London Metals Exchange, is examining claims that a portion of its metal flow in its warehouses originates from such mines. So that will become increasingly difficult to be used in the supply chain. So, and then recycling is another component to relieving cobalt shortages. I know that a number of recyclers now are looking at trying to find more efficient process flow sheets that will allow them to recapture and reuse some of the cobalt that's gone into depleted batteries. But these are all they all help around the edge, but they don't fix the fundamental problem, and that is that unless you have a major dramatic increase in copper and nickel prices, you will likely not have a material increase in cobalt supply. So So you're right. And then there will be substitution, as Nick has suggested, with some of the other non-battery users that are maybe able to substitute some less expensive materials, and this will all help, but it's not going to fix the fundamental problem, which is the world will be short of cobalt. Cobalt prices will skyrocket, and unfortunately, because it is not a primary metal of production, it's not necessarily going to incentivize new cobalt mine supply, since there is, with one exception, there is no such thing as a cobalt mine. There are nickel mines and there are copper mines that just happen to have a small cobalt byproduct, but there is no such thing as a cobalt mine, again, with one rather modest exception in Morocco.
To provide an idea of just how bad the shortage already is, and I may have heard this from you earlier this week, but there was a report that Volkswagen had gone to the market to secure either lithium and or cobalt. Ultimately, they were unable to get their hands on any and have now had to completely rethink their strategy on how to go about doing that.
Yes, so Volkswagen rather naively issued a tender, a request for tender for 10-year supply of a rather substantial amount of cobalt. I think it was, and this was widely reported in the press, so I'm not telling any industry secrets, for what amounted to something on the order of 20% of the world's, 20 or 25% of the world's current mine supply each year for the next 10 years. And furthermore, to rather add insult to injury, they asked bidders to quote a fixed price that was at a discount to the prevailing price. Well, as you can imagine, nobody responded to the tender because there were a number of problems. One is there is no such uncommitted supply available. And two, even if there was, nobody would be willing to deliver it into Volkswagen or any other end user at a discount to prevailing price. So Volkswagen, upon receipt by the deadline of zero offers, has had to go back and rethink. And I don't know what their next plan is. I think they now are probably much more sensitized to the realities of and peculiarities of the cobalt market, and realize that this is a bit different than maybe most other raw material supply. It's in short supply at present, and will be increasingly so. So I don't know what they do. Volkswagen, as you know, has announced that a target that by 2025, 25% of passenger vehicle sales by Volkswagen would be electric vehicles. Volkswagen, I believe, is the world's largest auto manufacturer by number of units. So it's going to struggle, frankly, to get sufficient cobalt supply between now and 2025 to make those internal targets. Just going to add one other thing. I think to the extent these shortages emerge as expected by industry participants, I think one other source of quasi-substitution is that the industry may not be able to get enough cobalt during this period to produce 100% battery electric vehicles, and may have to substitute instead to a degree that they otherwise wouldn't want to plug-in hybrids, which tend to use substantially less cobalt than battery electric vehicles.
Good point. Mike, a thought that just came to mind in listening to you, unique to cobalt possibly, is that there really are not very many bears out there. And if you talk about gold or silver, there are plenty of bears out there to argue a bull. Even in the case of lithium, I think there's quite a few. But the closest you'll really get to that in the cobalt space is someone who doesn't believe in the EV narrative. and we're still absorbing the cobalt as it is without a big EV market. Do you find that unusual for a commodity to not have anybody really on the other side of the sentiment?
Yes, that's a good point, and often instead of trying to argue as somebody that's long cobalt why the market won't be flooded as prices go up with additional supply, which will cause a collapse in price, which is typically sort of the commodity boom bust overreaction cycle. I find myself trying to explain how more cobalt units could possibly be produced or substituted out, as we've just talked about. So it's the first time in my 35-year career I've been in this position where you're kind of, there aren't any bears, as you say, and you're trying to argue why perhaps the world can find more of this metal to achieve the electric vehicle adoption rates that I think the market will demand.
Mike, the biggest winner of the automobile revolution 100 years ago was John D. Rockefeller, not Henry Ford. I did some research prior to this call and found that around the time that Henry Ford debuted the Model T, there was 241 automobile manufacturing businesses. And in the 20 years following that, that ballooned to 1,800. By 1929, though, only 44 of those remained. And what I'm, of course, getting at here is that you have a lot more certainty investing in the commodity rather than trying to pick a horse in the race like Tesla. So in the case of cobalt, how do you go about doing that?
Yes, well, that's interesting because it is a byproduct. There is, with one exception, no sort of pure cobalt play, and the largest cobalt producer is Glencore, who produces something mostly from its copper mines in the Congo, produces something like 20 or 25% of the world's supply. But cobalt represents something on the order, depending on the price assumption, 10% maybe of their revenue mix. So you could buy Glencore, but you're really not getting cobalt exposure. You're getting exposure mostly to the major metals that Glencore produces, which are things like copper and coal. So there is one pure cobalt play. It's called Cobalt 27. 27 is the atomic number for cobalt, and it was listed in an IPO in June of this year. It ended up being something on the order of a $230 million IPO, and it was designed specifically to do what you've just suggested, which is to give investors a pure, ultimately leveraged play on the cobalt price. And so the company is pretty simple. It has a market cap of something on the order of $240 million at the moment, and it consists simply of the largest stockpile of physical cobalt in private hands in the world, which is about 160 or 170 million Canadian dollars worth of physical cobalt sitting in LME bonded warehouses and cash, and so it's an unadulterated pure financial exposure to cobalt. And I know that the company has intentions of adding streaming deals whereby they would enter into cobalt streaming transactions with some of the few producers where cobalt is a minor, typically less than a 5% portion of their portfolio. And that would give, if they're successful in that endeavor, that would give financial investors a further leveraged exposure to the cobalt price. So that's how I have satiated my desire to get long cobalt. I am a shareholder of Cobalt 27. I think the ticker is KBLT on the TSX Venture Exchange, and that is the only pure cobalt play. I guess there's an exploration company called eCobalt, but for me that wasn't as satisfying because that's more of an exploration development play, and it may happen, it may not. I don't know. I was looking as a investor, short of having to try to buy the physical metal myself, looking for something that would give me direct exposure to the cobalt price, and for me, that's my preferred vehicle.
Mike, there are several cobalt branded companies on the venture exchange that have sprouted up, I should say, that have some type of claim to a past producing mine, and you've of course opted to look at Cobalt 27. My guess is that based on your investment background, you like to control resources and a substantial resource to get upside to a commodity, and it appears Cobalt 27, having that physically in a vault, is the best way to do it.
Yes, for me, in this case, in the case of cobalt, I prefer to have this, which is basically a sort of a pro rata entitlement on the metal that Cobalt 27 is holding in the warehouse, and or may have by virtue of a future streaming deal, to trying to figure out which of the many recently listed cobalt exploration companies has the best chance of actually finding a mineable resource. And again, I come back, it's a little bit different for cobalt too, because most of these so-called cobalt exploration companies are really not necessarily cobalt exploration companies. They're nickel cobalt exploration companies, or they're copper cobalt exploration companies, where the primary metal of interest is either nickel or copper. It just so happens, for marketing purposes, many of these recently listed companies have highlighted the cobalt byproduct component, but in fact, if you really sift through it, they're really exploring for and trying to assess the economic merits of a nickel cobalt or a copper cobalt. So rather than try to figure all that out and suffer a lot of brain damage, for me it was just a lot easier to buy Cobalt 27 and stick it in my desk drawer and go to sleep and wait for the cobalt price to really make what I think will be a major move as we go into 2018.
Mike, always a joy to have you on, and as a newer guest, I might add, I'm quite certain you've gained an audience faster than anyone I brought on, and retention rates across your interviews are near 100%. I even had one listener jokingly refer to you as an alien who's landed on our planet, and we're happy to have you here sharing your knowledge. So on that note, thank you so much for coming on the program with us.
Well, thank you. I'm not sure if that's high praise, but I'll take it as a compliment, and look forward to our next chat, which, because I'm really persuaded that this whole thematic of battery metals is real, and it's here to stay, and it's going to drive the metals industry for the next 5 to 10 years. So, good, Colin. As always, a pleasure, and thanks so much.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?